What's going on, everyone? Welcome to the channel. This is X Viper TV. And if you've ever heard about traders talking about futures and you've just wondered, what in the world are futures and how do they work? Well, you're in the right place. Today, I'm breaking down in simple terms so you can understand what futures contracts are, how they work, and why traders use them. Plus, we'll compare futures versus Forex to help you see key differences. Let's dive in. All right, so what exactly are futures? Futures are financial contracts that obligate a buyer to purchase or a seller to sell an asset at a predetermined price on a specific futures date. These contracts are commonly used for commodities like oil, gold, which is my favorite, and wheat. But they also exist for stock indices, currencies, and even Bitcoin. Futures trading is different from buying stocks because you're not actually buying the asset itself. You're agreeing on a price for the future. So how do they work? So let's say you're a farmer growing wheat and you're worried that the wheat prices might drop by the time you harvest. You could sell a futures contract now at a locked-in price to protect yourself from price drops. On the other hand, a baker that needs wheat could buy futures contracts to lock in the price and avoid paying more if wheat prices go up. And here's where traders come in. Investors trade futures to speculate on price movements, meaning they will try to profit by predicting whether prices will rise or fall. One of the biggest differences is that futures markets are highly regulated. Unlike Forex, where brokers operate in a decentralized market, every futures order must appear on official records, making the market fully transparent. In Forex, your broker might be the one taking the other side of your trade, so there's no dealing desk manipulating prices. Another advantage of futures is access to level 2 market data, also known as the depth of market, or DOM. This shows you real buy and sell orders in the market, letting you see how much liquidity is available at different price levels. In Forex, this type of data is often hidden because the market is decentralized and you're relying on your broker's feed. But in futures, you get full transparency. You see exactly where buyers and sellers are stacking their orders. Now, both markets offer leverage, but futures leverage is generally more structured. Forex brokers might give crazy leverage like 50 to 1 or even 100 to 1. I've seen even 500 to 1. But in futures, margin requirements are clearly set by the exchanges and brokers, keeping traders from over-leveraging themselves too easily. Now, the trading hours, Forex runs 24/5, but futures markets are open nearly 24 hours too, except they have official exchange hours, which can lead to more predictable price action. Plus, futures contracts often have higher liquidity in certain sessions, meaning better execution. So why would someone want to trade futures? Well, here are a few reasons. Some businesses may want to hedge risk. Businesses use futures to protect themselves from price changes like airlines locking in fuel prices. They also use it for leverage. Futures allows traders to control large amounts of assets with a small investment. This means higher profit potential, but also higher risk. And then also speculation. Traders use futures to bet on price movements if they can predict the market correctly. They can make huge gains, but if they're wrong, they can also lose a lot as well. Also with futures, there's more transparency. No hidden spreads or broker manipulation. You can see order flow and level 2 data, and your trades are recorded and protected by official exchanges. Also, futures is great for day trading and scalping, with lower fees and tighter spreads compared to Forex. Now, you also have to remember with trading futures, options, Forex, or anything like that, there are risks. Now, with futures, there's leverage. You can lose a lot more than you initially invested. There's market volatility. There's high swings in the market at any given time, at any given moment. And then margin calls. You can get your orders liquidated. Your whole account can get liquidated or margin called. Or you can be called up to actually put more money into your account in order to keep your positions open. Now, if this information helped you in any way, please give a like and subscribe. I'll be dropping more videos like this in the future, explaining futures, explaining different things, and we're gonna help beginners get into futures trading together. All right, this is X Viper TV.